The real force that moves the market is liquidity. Every major market move, every sharp spike, and every sudden reversal is driven by liquidity being targeted, collected, and redistributed by smart money. If you don't know where the liquidity is, then you are the liquidity. In this video, we're going to explain liquidity, break down the types of liquidity, importance of liquidity, and where to spot high liquidity levels. If you are interested in learning advanced trading concepts, strategies, entry techniques, and how to control your trading psychology to stay disciplined in your trading journey, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. A market with high liquidity is one where a large number of buyers and sellers are actively trading a particular asset. In these conditions, buy and sell orders are readily available, which means transactions can be executed quickly, smoothly, and with very little impact on price. But in smart money concepts, liquidity goes beyond just the number of participants. On the chart, liquidity represents clusters of pending orders and stop losses, areas where retail traders have placed their protective stops or breakout entries. These areas act like pools of orders waiting to be triggered. Smart money, or institutional traders, rely on these pools to fill their large positions. They sell at the highs, where retail traders are usually buying after a breakout. And they buy at the lows, where retail traders panic and sell during a breakdown. In simple terms, liquidity is the fuel that drives the market. Price moves toward liquidity because that's where the orders are concentrated. Understanding liquidity from an SMC perspective helps you see the market more clearly. It shows you where retail traders are being manipulated, where their stops are likely placed, and more importantly, where smart money is entering or exiting the market. There are two main types of liquidity, each based on the direction of orders: buy-side liquidity and sell-side liquidity. Buy-side liquidity refers to areas on the chart where sellers have placed their stop losses above a swing high or resistance level. When those stop losses are triggered, they turn into buy orders, providing the liquidity needed for institutions to execute large sell positions. Also buy stop orders placed by breakout traders who expect price to continue rising above resistance. All of these orders, stop losses from sellers and buy stops from breakout traders, cluster above major swing highs, creating a pool of buy orders. This entire zone forms the buy-side liquidity. On the other hand, sell-side liquidity sits below support levels or swing lows. This is where buyers place their stop losses to protect their long positions. Once triggered, these stops become sell orders, also include sell stop orders placed by breakout traders waiting for a breakdown below support. Together, these stop losses and sell stops create a dense pocket of sell orders below key lows, forming the sell-side liquidity, which smart money can use to fill large buy positions at discounted prices. Liquidity plays a crucial role in determining the direction of price movement. Without liquidity, financial markets simply cannot function, because every buy order requires a matching sell order, and every sell order requires a buyer on the other side. This balance of orders is what keeps the market flowing. When smart money, large financial institutions, wants to buy at a better price, they cannot just enter the market immediately. Their order sizes are too large. Instead, they intentionally move price toward sell-side liquidity, where a large cluster of sell orders exists in the form of retail stop losses and pending breakout orders. These sell orders give institutions the liquidity they need to fill their massive buy positions. This process of driving price into pockets of retail orders and absorbing them is known as a liquidity grab or liquidity sweep. Institutions clear out these resting orders across multiple price levels, collecting the sell-side pressure required to complete their entries. Once liquidity has been absorbed and their positions are filled, price often reverses sharply and begins moving in the opposite direction, now seeking liquidity at the next extreme. This constant cycle of collecting liquidity and shifting price is the true engine behind every major market move. To identify liquidity with precision, you must first understand where the market naturally builds pools of stop losses and pending orders. These liquidity pockets become the targets for institutional price movement. Liquidity can be categorized into external, major, and internal, minor liquidity. External liquidity forms around major swing highs and swing lows, usually visible on higher time frames. These zones attract the largest concentration of buyers and sellers, making them prime areas for institutional manipulation. Internal liquidity, on the other hand, builds around minor swing points within the lower timeframe structure. Although smaller, these levels still provide enough orders for short-term liquidity sweeps. Another highly reliable liquidity zone appears when the market forms equal highs or equal lows, two swing points at the same price level. Equal lows create a clean support line, often interpreted by retail traders as a double bottom or a strong buy zone. Retail trader enter long positions at the support line connecting the lows, or some will enter at the breakout of the neckline, with stop losses sitting just below the equal lows. These stop losses represent a perfect pool of sell-side liquidity. Institutions frequently drive price below the equal lows, triggering those stops. Once the liquidity is captured, price usually reverses sharply upward. Equal highs, commonly recognized by retail traders as a double top, operate in the same way as equal lows, but in the opposite direction. When the market forms two highs at the same level, it creates a clean resistance level that attracts traders expecting a reversal. Retailers enter short positions from the resistance line, or some will sell at the breakout of the neckline. As a result, a cluster of buy-side liquidity builds up above these equal highs in the form of stop losses from all the short sellers from different levels. Smart money targets this liquidity intentionally. They drive the price just above the equal highs to grab the buy-side liquidity, filling their large sell positions at premium prices. Once that liquidity is absorbed, the market typically reverses sharply and begins moving lower, leaving retail traders trapped on the wrong side of the move. Trendlines are another major source of liquidity in the market. A trendline becomes valid only when it has at least two confirmed touches, and once established, it attracts two distinct groups of traders. This is exactly what creates liquidity on both sides of the line. In an uptrend line, retail buyers often enter long positions directly from the trend line, placing their stop losses just below it. At the same time, breakout traders place sell stop orders beneath the line, anticipating a breakdown. Together, these stops and pending orders form sell-side liquidity below the trend line. The stop losses of traders who try to short the breakdown create buy-side liquidity above the trend line. Institutions frequently drive price below the trend line to trigger these orders, sweeping the sell-side liquidity to fill their large buy positions. After the sell-side liquidity is collected, price typically snaps back upward, taking out those short seller stops, buy-side liquidity, before resuming its bullish direction. In a downtrend line, the exact opposite happens. Retail traders sell from the trend line and place their stop losses above it, while breakout traders set buy-stop orders waiting for a breakout. This cluster of buy orders creates buy-side liquidity above the trend line. The stop losses of breakout traders then accumulate below the trend line, creating sell-side liquidity. Smart money often pushes price above the trend line to absorb buy-side liquidity. Once the buy-side liquidity is taken, price usually reverses downward, sweeping the sell-side liquidity next. In both scenarios, institutional traders efficiently collect liquidity from both sides of the market before driving price in the direction they intend. Flag patterns, whether bullish or bearish, are classic trend continuation formations, but they are also some of the most effective liquidity traps created in the market. In a bullish flag, price breaks above the flag's resistance line, and retail traders immediately interpret this as a genuine breakout. They enter long positions with stop losses placed below the flag's support line. Institutions often capitalize on this behavior by pushing the price sharply downward, triggering those stop losses and collecting sell-side liquidity. Once the liquidity is absorbed, price typically snaps back upward, breaking through the pattern with strength and continuing the larger uptrend. In a bearish flag, the opposite dynamic unfolds. Price dips below the flag's support line, creating the illusion of a breakdown. Retail traders rush to sell, placing stop losses above the resistance line. Smart money then drives price upward, sweeping buy-side liquidity, trapping sellers, before resuming the downtrend with even greater momentum. Another set of highly significant liquidity zones can be found at previous higher timeframe highs and lows. These include the previous monthly highs and lows, the previous weekly highs and lows, and even the previous daily highs and lows. These levels consistently attract large clusters of stop losses and pending orders, making them prime areas where major liquidity builds up. Institutional traders frequently target these zones to capture liquidity before moving price in the intended direction. That's it. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.